Hello Business 400. This accounting video demonstrates the change entry when there is a consolidation of parent and subsidiary in the presence of a downstream sale of intercompany inventory. The concept that we'll push on this video is the process of reconciling the equity investment account on the balance sheet of the parent to the T account reconstruction of that equity investment balance. The process that we will use will first create a T account assuming a 100% ownership of the subsidiary by the parent, and then breaking that 100% ownership into the 70% parent component and then the 30% non-consolidating interest component. The concept is the sum of the equity investment by the non-controlling interest plus the equity investment by the parent must equal the 100% equity investment situation. Another takeaway point from this video is the distinction between a downstream sale of intercompany inventory and an upstream sale of intercompany inventory. In a downstream sale of intercompany inventory, the parent will own 100% of the inventory profits because the subsidiary will own 0% of the parent's stock. Accordingly, the parent's share of the equity investment will always show 100% of intercompany profits, and the subsidiary will show 0% of the intercompany profits. In the opposite situation where there is an upstream sale, the parent 70% and the subsidiary 30% share in their ownership proportions in the deferred gross profit issues. And so the deferred gross profit amounts will be split between parent and subsidiary. Okay, let's take a look at this case here, which is a downstream sale of inventory, and 100% of the deferred gross profit will be attributed to the parent's share. To prepare the 100% ownership, the first step is to show the subsidiary's book value as of the beginning of the year. Recall that the parent's equity investment account is a mirror image of the subsidiary's owner's equity. So adding the common stock of the subsidiary at the beginning of the year, the additional paid-in capital of the subsidiary at the beginning of the year, plus the retained earnings of the subsidiary at the beginning of the year, will give you the owner's equity of the sub at its book value at the beginning of the year. Now, in this particular instance, the parent purchased the subsidiary at a $250,000 accounting acquisition premium, all of which was attributable to plant, property, and equipment. The plant, property, and equipment had a life of 20 years. So that means that the parent must amortize this AAP premium over 20 years or $12,500 a year. Since the parent purchased the subsidiary on January 1, 2010, and we are attempting to determine what the unamortized fair value of the subsidiary is at January 1, 2013, there will have been 1, 2, 3 years that have been expired since the acquisition, so that implies that there would be 20 less 3, 17/20ths of the $250,000 premium that would be unamortized. 17/20ths of $250,000 produces an unamortized AAP premium of $212,500. The problem description also indicates that the deferred gross profit in the intercompany sales as of the beginning of the year were $12,250. In a downstream sale, the parent has sold to the subsidiary. So the subsidiary's inventory is overstated as of the beginning of the year. If inventory is overstated, that means that the sub's owner's equity is overstated. The parent's owner's equity account is a mirror image of the sub's owner's equity, so if the sub's owner's equity is overstated, the parent's equity investment is overstated and must be reduced by the overstatement due to beginning inventory profits. So deduct 100% of the beginning inventory profits. Adding the increases less the deferred profit in ending inventory gives an equity investment of the parent of $603,400. Now, let's do the changes in the sub-income account. The subsidiary had income of $416,870, of which the parent will pick up 70%. Also, we must take one more year's AAP amortization on the premium. So $250,000 divided by 20 produces additional amortization of $12,500, of which the parent will pick up 70% and the subsidiary will pick up 30%. Now, an error in beginning inventory causes an opposite error in income. Because beginning inventory was overstated, current year's income will be understated. So the 100% case would increase credit equity income by $12,250 and increase equity investment by $12,250. Because the parent owns 100% of the gross profit on that inventory sale, the parent would pick up 100% of that deferred gross profit, and the subsidiary would pick up none. Going to the end of the year, the deferred gross profit in ending inventory would be $19,600. That means that the sub's ending inventory would be overstated, its owner's equity would be overstated, and accordingly the parent's equity investment would be overstated. To eliminate the overstatement, the parent would decrease equity investment, understatement of the cost of goods sold of the subsidiary. The parent picks up 100% of the overstatement, the subsidiary would pick up none of it. The subsidiary paid $14,007 of dividends, which reduces the owner's equity of the sub, and accordingly the equity investment of the parent. The parent picks up 70% of that dividend, the non-controlling interest picks up 30%. Adding all the increases, deducting the decreases, that produces the equity investment of the 70% parent, $869,304, which ties in with the amount on the balance sheet, $869,304. Also, we should create the equity investment of the non-controlling interests, $380,959. Okay, we are just about ready to create the journal entry for the change case. But before we do, let's reorganize these change elements in the parent and the non-controlling interest accounts so that we can see the result a bit better. Let's start with the change values in the parent and the non-controlling interest accounts. We will take the net income that was earned, 70% to the parent, 30% to the non-controlling interest, and deduct 70% of the AAP amortization from the parent's account and 30% of the AAP amortization from the non-controlling interest account. we add 100% of the deferred gross profit in beginning inventory to the parent and deduct 100% of the deferred gross profit in ending inventory in the parent's account. Adding the income, deducting the appropriate items, that produces equity income of the 70% parent's interest, $275,709, which eliminates completely the $275,709 that appears on the parent's income statement. And we also must reduce the non-controlling interest's income by $121,311 likewise, because when we add the two income statements together, we will have already accounted for that same income. Dividends that the sub pays does not result in income to the parent, but does reduce the equity investment account of the parent, so we will deduct 70% of the dividends from the parent's account and 30% of the dividends from the non-controlling interest account. In doing so, that ties into the equity investment account that we have for the parent and will give us the desired ending balance in the non-controlling interest account as of the end of the period, at least the amount of the change in the non-controlling interest account. Okay, now let's apply this table to the C entry. First, we want to eliminate the equity income of the parent. To do so, we debit the equity income account. We also want to eliminate the double counting of the income for the non-controlling interest, so we will debit or reduce the equity income for the non-controlling interest, $121,311. Additionally, we want to reduce the equity investment of the parent, so we will credit the equity investment of the parent, and now we want to create the equity investment of the non-controlling interest, so we will credit the non-controlling interest equity investment $117,109. Additionally, we need to eliminate all of the dividends paid by the subsidiary, so we will credit the dividend account of the subsidiary $14,007. Well, there you have it. This set of schedules explains the journal entry for the change portion of the consolidated entries. Give this a shot. Have fun.